Hi, everybody. We are back with another installment of some economics. Last couple of videos, we focused a little bit more on some of the minutia of how the Federal Reserve is able to manipulate the money supply, really by controlling the base. What we're going to do now is take a look at a theory that applies in the short run, which more or less describes how the Federal Reserve or the central bank is able to manipulate interest rates, specifically nominal interest rates, by controlling the money supply. Keep in mind, this is not our first time looking at this idea of interest rate determination. In fact, we started off in a pretty simple framework in that neoclassical model, looking at the loanable funds framework for thinking about how savings and investment determined the real interest rate. Again, this was more of a long-run model. It didn't really require us to think about money growth because this was determining real variables, not nominal variables. And then we shifted gears a little bit, and we thought about a long-run model that explained the relationship between money growth and inflation. And this was the quantity theory. And when we combine the quantity theory with the Fisher effect, again, the quantity theory, again, suggesting that money growth translates into inflation, and the Fisher effect suggesting increases in inflation push up nominal interest rates. The combination of these two suggested a direct relationship between the growth rate of the money supply and the nominal interest rate, and this was a long-run mechanism. We're going to introduce next the theory of liquidity preference, which is consistent with Keynesian economics. This theory also has a supply and demand interpretation or supply and demand framework that explains how nominal interest rates are determined in the short run. Okay, so one of the strange things you'll notice is these two intermediate bullet points here, intermediate bullet point 2 and 3. They're going to suggest dramatically different predictions in terms of how the central bank growing the money supply affects nominal interest rates. The quantity theory and the Fisher effect suggested that growing the money supply pushed inflation up, and in the long run, this pushed nominal interest rates up. But what we're going to see in a minute is the liquidity preference theory actually makes the complete opposite prediction regarding money growth and nominal interest rates in the short run, in that money growth in the short run tends to cause interest rates to go down, not up. So again, this is a Keynesian model, meaning it applies in the short run when prices tend to be a little stickier, prices don't adjust as quickly. And one thing we'll kind of be able to do is abstract away from worrying about inflation in the short run, because if we're dealing with a very thin time horizon or a very small time horizon, prices aren't able to change dramatically over very small periods of time. For example, in a day, prices don't change that much. In a given second or milliseconds, prices are essentially fixed. So in the short run, we're able to abstract away from worrying about this issue of inflation. And the theory of liquidity preference is essentially predicated on the idea that money as a liquid asset provides you some benefit in order to transact with. Okay, so you need to hold money to achieve this benefit. However, there is a cost, and that is, in order to hold this liquid asset, which is money, you are giving up the return you could make by investing in other financial assets, for example, bonds or stocks. So basically, you can think of the nominal interest rate, I, as some measure of your opportunity cost of holding money. It's the rate of return that I'm giving up from holding cash or from holding money that I could have made by investing in another asset. But the problem is there's a trade-off, and the trade-off is the other assets are not as liquid. Okay, so in order to negotiate this trade-off, this is how individuals determine the amount of dollars that they want to hold as cash. So we're going to assume here that the money demand curve is inversely related to the nominal interest rate I. And the money supply curve, we are going to treat as exogenously fixed by the central bank. So it's a constant that the central bank chooses. And remember from our previous discussions that the central bank doesn't really have this godlike control over the money supply. They control the base, and the behavior of consumers and FDIC member banks, or really the member banks in the central banking system, jointly determine the currency to deposit and reserve to deposit ratios, respectively, which determine the size of the money multiplier. And we saw this phenomena in the last few videos. So the money demand function, I'll use an L to represent liquidity, is the what we're really demanding by holding money. And this depends inversely on the interest rate, right, or the rate of return that I can make in the financial market. And we're going to assume here that your money demand depends positively on your expenditure level, where your expenditure we can proxy by your nominal spending, or the price level times your real income. And the idea is that if you need to spend more, then your demand for holding cash will typically go up. Okay, so higher nominal income, more spending, so we need more money to facilitate those transactions. And we're going to basically argue that the interest rate in this model is determined where the supply of the money and the demand of money meet at equilibrium. Okay, so the money supply, this is determined exogenously by the central bank. And the money demand, this is determined by, again, total spending and individuals' preferences towards facing this trade-off between holding liquid asset, being money, versus holding some sort of financial asset like bonds or stocks, which pay you an interest rate I, a nominal return of I. Okay, so here is what the picture looks like now. We got the nominal interest rate, or you can think of the price, the cost of holding money on the vertical axis. And we have the quantity of money on the horizontal axis. And again, we're assuming here the central bank has this godlike or omniscient control over the quantity of money. And the consumers decide, in facing this liquidity preference trade-off, how much money to demand at a given interest rate. And the idea is that the market gets pushed towards an equilibrium nominal interest rate where the supply intersects the demand for money. Okay, and now, given this framework and given our past discussion of equilibrium analysis, it shouldn't be too difficult for us to think about how the Federal Reserve, changing the money supply, can now be used to manipulate nominal interest rates. Right? For example, if the Fed were to pursue an expansionary monetary policy and increase the money supply, then for a given level of money demand, a rightward shift in this money supply curve is going to put downward pressure on that nominal interest rate as the supply curve shifts to the right. And note that this essentially makes the opposite prediction regarding money growth and interest rates, specifically nominal interest rates, compared to the quantity theory and Fisher effect framework. Here, the money supply growth, according to the theory of liquidity preference, actually pushes nominal interest rates down, whereas in the long run theory, the quantity theory, money supply growth pushed inflation up, which through the Fisher effect tended to push nominal interest rates up. Okay, so we're getting something funky here in the short run and long run models of how we relate money growth to nominal interest rates. These two models are making the complete opposite predictions. Okay, the other thing we could think about is, well, what happens if consumer preferences for money changes? So for a given money supply, we could consider a shift in the money demand curve. For example, let's suppose banking transaction technology changes and consumers respond by increasing their money holdings. And then you would get a rightward shift in the money demand curve. And if the Fed doesn't do anything, okay, this would cause an upward pressure on the nominal interest rate in the market for a given level of the money supply. Okay, so we can think about rightward and leftward shifts in the money supply curve, rightward and leftward shifts in the money demand curve. Again, what would cause a rightward shift in money demand? Well, things like increased expenditure would cause a rightward shift, and decreased expenditure would cause a leftward shift in the money demand function. All right, now, important point of note here is to relate this model back to the quantity theory, which I've suggested gives us dramatically different predictions in terms of the behavior of money and nominal interest rates in the long run. The quantity theory does provide a better explanation of the long-run behavior of money growth and nominal interest rates when we pair it with the Fisher effect. The liquidity preference theory, on the other hand, better explains the short-run behavior of nominal interest rates and money growth. And we have a little bit of anecdotal evidence here in terms of a case study, a policy case study. And in this mini case study, we're going to basically take a look at the effects of monetary tightening. And we have a comparison here of short-run and long-run models. Okay, the short-run model, again, is predicated in this Keynesian framework of liquidity preference. And in this framework, again, the assumption is that prices do not adjust quickly. And the prediction is that when we tighten up the money supply, meaning you restrict the money supply, this tends to drive nominal interest rates up. Okay, and during the monetary tightening of the late 70s, early 80s, the prediction here looks pretty solid in terms of liquidity preference. We see here in August of 79, nominal interest rates were about 10.4%. However, in April, about a year later, the nominal interest rates have increased now to 15.8%. So this is fairly consistent with the prediction of the liquidity preference model. However, in the long run, when we're using the quantity theory and the Fisher effect to make our predictions about how money growth affects interest rates, the prediction would be the opposite, that reducing the quantity of money actually reduces long-run inflation, and this puts downward pressure in the long run on the nominal interest rate. Note again, measuring at the same starting point now, but going several years out, we can see that in January of 1983, the nominal interest rate is now down to 8.2%. Again, more consistent with what the quantity theory and the Fisher effect are predicting when we reduce the money supply in the long run. So these models, they give us really complete opposite predictions when it comes to how money growth affects interest rates. So understanding whether or not you are thinking in the short term or thinking in the long run is actually really important when it comes to monetary policy. I wanted to just wrap up by thinking about the ripple effect that is induced when the central bank cuts interest rates and how this is used to stimulate economic activity. And I know you guys have looked at some short-run models as well in some of the online homeworks. But recall that interest rates are inversely related to investment as well as consumption components of GDP potentially. As the interest rate goes up, the cost of borrowing increases, so people are not as willing to take out as many loans, less investment demand, and less consumption if you finance consumption activities through the credit card. Also, the benefits of borrowing if you're starting up an operation are smaller, since that at higher interest rates, the future income you generate is not worth as much to you today. So increased interest rates, they increase the cost of borrowing and they reduce the benefit of borrowing. Both implying unambiguously that an increase in the interest rate tends to be associated with a drop in GDP. So if the central bank was interested in stimulating output or stimulating GDP, liquidity preference implies the following ripple effect, the following mechanism. If we were to cut interest rates using the liquidity preference model, this requires the central bank to grow the money supply by growing the base. And doing so pushes nominal interest rates down. Okay, once the interest rates drop, lower interest rates imply higher levels of investment and potentially consumption. And since those are components of GDP, this causes GDP to go up. Okay, more investment, more consumption means that firms need to increase output. They got to produce more goods and services. And as a consequence of that, the firms need to hire more workers. So this is where the relationship between interest rate cuts and trying to control unemployment comes in. When we cut the interest rates, output goes up and we get a temporary reduction in unemployment because we put some people back to work. As these folks are working, they're earning more income, which means they can afford to consume more. So again, kind of go back to step 3 here, but there's a slightly more the smaller tail of the ripple now, where the increased income for workers leads to more consumption, which leads to more output, which leads to the hiring of more workers, which reduces unemployment. And again, we can sort of think about this ripple effect feeding itself smaller and smaller and smaller as the ripple dies out from the short run interest rate cuts. In the long run, what happens? Well, if you cut the interest rate too much by growing the money supply, then at some point inflation kicks in the long run, and that starts to push the interest rates back up, which are the dangers of high inflation that the central bank typically has to negotiate when weighing essentially this trade-off between trying to cure unemployment and trying to not cause too much inflation in achieving that task. So I've posted up an interesting paper. It's called the Capitol Hill Babysitting Co-op, and it's an interesting story about liquidity preference and basically about how in this voucher system, in this mini economy that is all these parents trading babysitting services with each other on Capitol Hill, this economy goes into a little bit of recession. And the solution, as you'll see in the reading, is to pump money, pump liquidity into the economy to stimulate it, as we have mentioned, more or less consistent with this ripple effect outlined in red on the slide here. So please take a look at that paper, Capitol Hill Babysitting Co-op. It is an interesting story regarding liquidity preference, and I will see you shortly in the next set of videos. Enjoy.